everyone, a very good morning to everyone. I hope that I am audible, my screen is visible, everything is okay. So today we are going to start module D MCQs. In the previous classes we already covered module A, module B, module C. Now today turn is module D. So let's start, and I am showing one by one all the questions. You have to give the answer of the related questions. Okay, then we will cover all the concepts, and then I will provide you the PDF for the practice, so you can do also the practice with some extra questions, and I will provide answers also. If you feel any problem, kindly do the comment. And sorry for some voice due to cold, maybe it creates some problem, but ignore this. And this is the first question in front of you. In the context of ALM, which of the following most accurately reflects the rationale behind segregating bank liabilities into core and volatile categories? So, first thing is, can you tell me about what is ALM, asset liability management, in the context of banking? See, basically asset liability management, that is a strategic framework, right? That needs a strategy for the banks to manage and balance their assets and liabilities, to mitigate the risk, to ensure there is enough liquidity, to optimize the profitability. It involves managing the mismatches between assets and liabilities that basically arises from the difference in timing and sensitivity to the market factors. uh, uh, like what type of market factors? Like that is interest rates. So that we can say it is a asset liability management. So which answer is correct? Evaluate every option, ABC option. And as I told you, asset liability management is about assessing the maturity mismatches and all the liquidity risk exposure that is based on behavioral characteristic rather than contractual maturities. So the correct option is option B here. Next question. Read this question. So according to this question is saying, which of the following is most consistent with the regulatory intent of section 29 of the Banking Regulation Act 1949 in the context of financial reporting by the banks? As you know that banks have to provide the final snapshot, right? And we can see that thing about the about the condition of the banks just due to their financial statements. That's why it is saying that financial statements are the snapshot of the bank, yeah, or any financial institution. So what section 29 is saying? It mandates that all the banking companies in the India, as well as all the foreign banks that are operating through their Indian branches, they have to prepare, they have to submit a balance sheet and a profit and loss account at the end of each calendar year as a specified 12-month period. These financial statements must be prescribed in the forms that is set out in the third schedule of the Act, or as close to its circumstances, that is allowed. So the purpose of this section is to ensure transparency and as well as provide a clear financial picture of the bank operations for the public and regulatory authorities. Now evaluate which option is correct here. See, this is option B. Obviously, mandatory. It is mandatory to be uniform and to maintain the standardization in the presentation of financial position through prescribed balance sheet formats. So the correct answer is here option B. I hope now this is clear after the explanation. Next question. Which of the following best describes the primary regulatory purpose behind classifying bank advances into secured, guaranteed and unsecured categories in the financial reporting? Secured, guaranteed and unsecured categories. Which option is correct? See, basically when we are doing a financial reporting as a bank or any financial institution, loans and receivables, they are classified as secured or unsecured and further things are categorized according to their credit worthiness. Secured assets are backed up by collateral while unsecured assets lack collateral because there is higher lender risk and interest rate, whereas the guaranteed category refers to an assurance of payment which can be applied to both secured as well as to the unsecured debts, but it is associated with financial guarantees or insurance that protect lenders from the default. So which option is correct here? Yes, to enable calibrated provisioning, capital adequacy assessment and transparency in risk exposure. That's why this is the best description of the primary regulatory purpose. Is that clear? Which of the following would not be considered sorry, a direct component of a bank cash and balance with RBI under statutory reporting? Cash and balances with RBI. What does it mean, cash and balances with the RBI? See, cash and balances with RBI means obviously funds that a bank holds either as physical cash or as deposits in its current account with the RBI, which functions as a country's central bank. Banks are mandated to hold a portion of their liabilities as cash reserves with the RBI to manage monetary stability, and these balances are an important component of a bank overall liquidity. So which option is correct according to this? Let's see. Here, the correct option is option C. When overnight placements in the interbank call money market, that would not be considered as the cash balance, because that balance will be there for only for one night. So how can we can say that is the cash and balance? Foreign currency notes held, that we can consider. Funds that are maintained with the RBI, that we also can consider. Balances in the current account with the RBI in excess of CRR, we can consider this one. But one night fund, we can't consider as a bank cash and balance with the RBI. So the correct answer is here option C. Which of the following is mostly appropriately classified under other income in the P&L account, profit and loss account? Other income in P&L. See, other income we can consider that revenues which are from the secondary sources, right? Sorry. Sorry for this. Other income in a P&L account refers to the secondary revenue, secondary sources revenue, which are not related to the company's main business operations, such as interest on investment, dividends, rent received, gain from the sale of assets. These types of things we can consider as the other income, right, in the profit and loss account. So which option is correct here? Commission earned on issuing letter of credit, we can consider is the other income in a commercial bank profit or loss account. So option C is correct here. Which among the following would not be included under interest expended in the profit and loss statement of commercial bank? Because why I am asking these questions, because in the module D we generally include the components of asset and liabilities and management of these things. The whole module depends on this, right? So simply interest expended, this is not included, because obviously salary is not related to any interest, right? Salary is not related to any type of interest expended. All other are okay with the interest expended. So option D is, we can't consider this as the interest expended in the P&L account of a commercial bank. Which of the following is not a part of operating expenses for a commercial bank? What are the meaning of operating expenses? See, this is okay. This is very good for this module is very good who are from the commerce background, right? But for science background, this is I can think that these things are little bit new because in science we generally not learn about these things. So which of the following is not a part of operating expenses? Okay, sorry. Operating expenses means these are the everyday cost. Just a business incur to keep its operations running. But uh, these are not related to a specific product. These are related to the like daily stationery expense or office supplies, marketing, payroll, rent, utilities. These all are called operating expenses. So the correct answer is here: provision for non-performing assets is completely not related to the operating expenses. So option C is correct here. Is that clear? In the context of ALM, which of the following scenario most clearly demonstrate a liquidity mismatch risk? Read all the scenarios and then take the decision. You can also give yourself marks. So that will also help you out to learn the things that where is the weaknesses and where are your strength. See, what is the meaning of liquidity mismatch risk first? Liquidity mismatch risk when there is a mismatch between assets and liabilities where the assets can't be easily liquidated at market value to meet the short term applications. So it is very critical to manage the liquidity to ensure that cash needs are continuously meeting. So the correct answer is here option A, lending long term home loans using short term saving deposits is clearly demonstrating liquidity mismatch risk. Because of this activity, it is 100% sure that bank will face liquidity mismatch risk. Clear? Next question. Which of the following best reflect reinvestment risk in the context of asset liability management? Reinvestment risk. Reinvestment risk means reinvestment risk means is the possibility that you will earn a lower rate of return when you reinvest the cash flows, right, from an investment that you did on the original investment. So this is when you are earning a lower rate of return when you reinvest the cash flows from the investment that you did on the original investment. So the correct answer is here option B. When a borrower prepays a long-term loan during a falling interest rate regime, so that borrower thinks this is the correct uh, chance to pay the long term loan because interest rate are now fall. So that's why option B is the correct answer here. In the ALM, which embedded option poses a refinancing risk and how should it be interpreted? Refinancing risk. See, refinancing risk is the possibility that basically a borrower with an individual or company is unable to secure new debt at acceptable terms to repay the existing debt when it matures. So basically we can say that here which of the option is following the refinancing risk, that is depositor right to withdraw the funds prematurely, that depositors have a right to withdraw their funds anytime. So that's why the option B is correct here. Which of the following most accurately reflects the dual objectives of ALM at the micro level? Dual objective of ALM at the micro level. Maintaining the liquidity is one of the main thing, and ensuring the profitability. This is only the dual thing, that profitability will be there and also enough liquidity will be there. This is the primary objective of the ALM at the micro level. So the option C is correct here. Which of the following best illustrate positive interest rate sensitivity gap and what does it imply? Simple positive interest rate sensitivity gap is when rate sensitive assets are greater than rate sensitive liabilities, that is benefiting the rising rate scenario. So the option B is correct here. Got it? Next question. Now tell about the ICAP under pillar 2 of the Basel third framework. What is the intention of ICAP? Read the options. What is ICAP? Under Pillar 2 Basel III framework, ICAP is a mandatory process for banks to conduct their own internal assessment of capital, which is needed to cover all their material risk, which include those not fully captured by minimum regulatory capital set in the Pillar 1. So the correct answer is there, option C. Here banks have to assess and allocate the capital for residual, concentration and reputational risks that are not covered in Pillar 1. So the correct answer is option C. Next, under Basel III, which configuration of risk assessment approaches align with the increasing complexity and risk sensitivity which is advised by the framework while maintaining compliance with the regulatory minima? Read the options and give the answer. C. The correct answer is there, option C, because there is a basic indicator approach method is for the operational risk, standardized approach is for the credit risk, standardized duration approach is for the market risk. So the correct answer is there, option C. Tell me the formula here of the total risk weight assets. That is option B. Risk weight asset formula is whatever the credit risk weight assets plus 12.5, then multiply with the market risk capital, then add and then multiply 12.5 by operational risk capital. This is the answer, that is the option B, which is correct. Under the supervisory review process that is outlined in the Pillar 2 of the Basel III, which of the following is not traditionally addressed through the internal capital adequacy assessment process? Supervisory review process, in which basically banks, when they are falling or when they are not able to maintain their minimum capital requirement, in that case regulators intervene and provide direction to the banks that do this thing, this is right thing. So you can tell me now which of the following is outlined in Pillar 2 of Basel III. That is general business risk. This is not, we can include in this ICAP under Pillar 2, because this is arising from the currency translation gains. Currency translation gains, whatever the things are there from this, basically from the general business risk that arises just due to these currency translation gains. We can't include them into the ICAP. Is that clear? Next question. According to the ICAP, which of the following actions by the बैंक जिनको हम कंसिडर कर सकते हैं एज अ वायलेशन ऑफ द प्रिंसिपल ऑफ प्रोपोर्शनैलिटी अंडर द बेसल थर्ड फ्रेमवर्क? What is principle of principle of proportionality? That is basically regulatory requirements, and obviously the supervisory intensity of a bank size, complexity, risk profile, rather than applying a single one size that fits all standard to all the institution. That depends of on every bank, what is the size of that bank, what is complexity there, what is risk profile there. So we can say that according to this, which is not considered here, which of the following considered as the violation? That is option C. A large international bank that using a basic spreadsheet model to measure aggregate risk, that would be considered as the violation of principle of proportionality. Why? Because when a large, obviously in a large international bank, a basic spreadsheet model is not enough. So that's why the option C is correct here. So which of the following correctly aligns the supervisory review process principles with the regulatory expectations under Basel III? Read each option. Yes, principle 3, that authorizes RBI mandate capital buffer that are exceeding the minimum norms. So the answer C is correct. Principle 3rd, which authorizes the RBI mandate the capital buffer that exceeding the minimum norms. So the option C is correct here. In the context of ICAP framework for moderately complex bank, which of the following practice reflect a misalignment with the expectations that outlined under the Basel Pillar 2 approach? Which approach is correct? that assumption that banks internal models that are fully reliable and that are not requiring validation if historical performance is strong. These is the this is the basically misalignment, that basically models are fully reliable and that require no validation if historical performance is strong. So there is a bank, small size bank, which having limited complexity intents to implement ICAP based on its business model. So which of the following combination of these activities that represents an appropriate proportional approach to ICAP implementation under the Basel framework? Option C. Identification of largest historical losses, any big loss in the history, analysis of likely recurrence that this type of thing will be happen, basic scenario testing, and documented capital planning that involves senior management that represents appropriate proportional approach to ICAP implementation under the Basel framework. So, which of the following most accurately reflects the forward looking nature of ICAP under the supervisory framework? Best, most accurately reflects the forward looking nature of ICAP. Because ICAP is very good in making the strategic objectives like with proper strategy. Also, it helps in making the developments and all the constraints in the capital planning. So, this is accurately reflects the forward looking nature of the ICAP under the supervisory framework. So, this answer is correct here. Next question. Last 5 questions. So, give the answer. Which of the following of the key operational expectation? What is the key operational expectation? Just a second. Sorry for that noise. Key operational expectation. The bank have to document assumptions, like make a proper documentation of all the assumptions that used in the aggregation and that are assessing volatility of correlations, that is particularly under stressed conditions. Obviously, when we are making a document, that is a operational expectation. Operational expectations means like all the decisions have to write in a proper things, all things are in the proper things that are, we can say, document, the assumptions are called operational expectations, right? So this answer is correct here, that is option C. Is that clear? Now, which of the following most accurately reflects the RBI expectation from a bank ICAP regarding model based risk assessments? Give the answer of this question. Option is correct here. That is option C. All the assumptions, all the parameter sensitivity, all the model limitations and the validation techniques that is used to disclose for each internal model used. This is the correct answer here. In the context of ICAP, which of the following is least consistent with sound stress testing practices as it is prescribed with the RBI? Sound means good, very good. Yes, scenario analysis focuses on the events with high likelihood and low severity. So A option is correct here. Just a second. Okay. Now under the ICAP framework, when we are aggregate various types of risk to determine the capital adequacy. So which of the following statement best represents sound regulatory expectations. Serious answer is whenever the correlations assumptions are there, they must be justified and they must be tested under stressed condition. We can consider this as the best representation of sound regulatory expectation. So the correct answer is option C. Next, under the Basel third framework, which of the following disclosures must be reported at least quarterly by the banks as per the RBI guidelines? Capital adequacy and credit risk under standardized approach that must be reported by the banks according to the RBI. So the option B is correct here. According to the Pillar 3 requirements, what is the primary rationale for requiring disclosures at the top consolidated level of a banking group? Clear answer is option C, because obviously Pillar 3 is saying maintain transparency. That transparency so investors, stakeholders, shareholders, they know about the bank's actual position. So the correct answer is option C. In the context of materiality under Pillar 3, which of the following best reflects when bank have to disclose a piece of information? Option C, when its omission could influence a user economic decision. When its omission that can influence a economic decision. So that statement is one of the best to tell all the peoples. Okay. So this is about the module D MCQs. Some other extra MCQs I will be provide you the PDF, so you can do the practice. I will provide the answers too, right? So if you have any type of issue, you can ask me in the comments. You can tell me that what type of things you want in the future, in the upcoming video sessions. You can tell also that thing. So that will also help me to understand your priority. So I hope that it is clear. If you like this video, kindly give the like, and if any problem is there, so you can ask me. So thank you so much. Let's meet in our next class. Till then, take care and have a good day all. Thank you.